Good morning and welcome to this Green Room webinar. Thank you all for joining us. Today we will be talking through our recent data centres report and exploring some of the key considerations for investors in the sector. Before we get started, I'd like to acknowledge the traditional owners of the land from which we are streaming from today, the Wurundjeri people of the Kulin Nation, and I pay my respects to all elders past and present and recognise their continuing connection to land, water and culture. I'm Julia Hinwood. I look after infrastructure investment at the CEFC, where I've been employed for the past 9 years, focusing on investing to reduce the carbon footprint of infrastructure assets. We have two exciting guests here for our discussion today on navigating investment in sustainable data centres. We have Rebecca Vallance, Senior Manager at Baringa Management Consulting. Rebecca has led work on our recently published report, and she also has spent the last 15 years working across the energy industry, specifically with retailers, networks, large energy users and government, where she supports organisations in shaping their decarbonisation strategies, securing their energy needs, investing in future energy technologies and capturing market opportunities to help enable the future energy transition. Our other speaker, bringing an international perspective on sustainability investment, is Cornelia Gomez, Managing Director, Global Head of Sustainability at General Atlantic, a leading global investor across growth equity, credit, climate and sustainable infrastructure strategies. General Atlantic has approximately 118 billion in assets under management, with more than 900 professionals in 20 countries. Based in London, Cornelia oversees the firm's sustainability strategy for all its asset classes and drives value-driven sustainability initiatives across its global operations and for its growth, climate and credit portfolios. So welcome, Rebecca and Cornelia. Today's session will run for about an hour, including a chance for audience Q&A at the end. You can ask questions at any point throughout the webinar using the Q&A box on your screen. We've had over 800 registrations, so we're expecting some interesting questions and we'll answer as many as possible at the end. Once today's session ends, you'll see a short survey pop up on your screen and we'd be grateful for your feedback. We commissioned the data centres report with Baringa to establish more mature information on the expected growth of the sector in Australia, the resulting growth in energy usage and its impacts on Australia's grid and emissions, and to consider how we could potentially use our investment at CEFC to drive a stronger focus on emission reduction from data centres in Australia. The report also considers potential for technical innovation in managing these energy loads and the role of policy in driving sustainable data centre growth. Today's focus is on what investors should be considering when they are investing in this sector and the role they can play in ensuring the sustainability of data centres. You'll also see the report and the summary slides we referenced today linked in the webinar console, and I encourage you to take a look at these. As well, we've provided a link to General Atlantic's white paper on the sector, which is also a very interesting read. I will now hand over to Rebecca and she will run through the report's key findings.
Okay, so this slide is a great illustration of the juxtaposition of opportunities and challenges presented by the projected data centre development in Australia. So on the one hand, we have an $85 billion plus investment opportunity, and that's from data centres alone. So that's not including the knock-on impacts of investment in the energy sector. And on the other hand, we have the challenge that data centres create for the energy system. So as you can see in some of the stats here, potentially consuming up to 11% of energy use by 2035, up from only 1% today. So a huge increase in demand. If we move on to the next slide. What we did as part of this work was create a view of potential data centre pipeline in Australia. To do this, we took a bottom-up view. So we undertook desktop research, we spoke to networks and others to inform our view of projects which were coming on stream. We developed the high case, which basically just assumed that all projects in the pipeline would come to fruition. And we then applied a number of sensitivities around the projects. So, ones which we would expect to get approvals or not. And also taking account of some of the duplication that we know is in the connections queue, for example. We then applied those sensitivities and created our central case. Now this gave us the rated capacity, so that's the nameplate capacity of data centres, which is expected to grow somewhere between 4.7 gigawatts, which is the central case, and up to 7.4 gigawatts, the high case, by 2034-35. Now, in order to get the operational capacity, which is what you see on this chart here on the left, we've made assumptions around the type of data centers and associated ramp rates to develop a pipeline of between 2.2 and 3.2 gigawatts of operational capacity by 2034-35, equating to a compound annual growth rate of between 23 to 27%, so significant. Importantly, we expect that more than 75% of this demand will be concentrated in the Western Sydney and the Northwest Melbourne areas. And I guess it's important to say that this pipeline, this view, which aligns pretty much with other industry expectations, so the AMO scenarios, for example, is a realistic view of today, but what it doesn't do is take account of efficiencies or innovations which are highly likely to emerge from the industry. So we would expect some additional sensitivities to be applied to this pipeline in the future. If we move us on to the next slide. So we took that pipeline that we developed and ran a number of scenarios to understand the price and emission impacts from expected data center growth. Before we dive into some of those results, I think it's important to understand some of the drivers behind those impacts. Data centers typically have a flat load profile, meaning they use energy fairly consistently throughout the day and night. Renewable generation, however, peaks during the day when we have an abundance of sunshine and drops off at either end of the day. So data centers therefore have a positive effect of soaking up excess renewables during high solar periods in the middle of the day, reducing curtailment, and through our modeling we can see that reducing curtailment of up to kind of 1.4 terawatts per hour of renewable generation. But conversely, they increase the base load during peak periods in the morning and evening, as well as overnight, where we become more reliant on more expensive thermal generation. And that's typically what pushes up the price impacts. Building out battery storage systems to capture excess daytime renewables and which discharge during the morning and peak period will help to flatten the green line that you see on that chart there, having a significant positive impact on that dynamic that we just talked through. If we move on to the next slide. As illustrated in the coloured boxes at the top of this slide here, we modelled a number of scenarios to understand the impact of projected data centre demand on wholesale prices and grid emissions in particular. Scenario 1, where we see no mitigations, illustrates additional data centre demand with no additional renewable build-out, which has a significant impact on prices. We saw rises of 26% in New South Wales and 23% in Victoria, along with a 14% increase in grid emissions across the NEM. The differences that we see in price impacts and grid emissions across the states is driven by the differing quantities of data centre load, as well as the varying underlying generation profiles within those states. So really importantly to note that although these impacts for scenario 1 are significant, we don't really see scenario 1 as a likely outcome, and this should be seen very much as a bookend. The increased demand signals coming from data centres, along with new policy support mechanisms such as the Electricity Services Entry Mechanism, the ESEM, for example, and continued build out in RES infrastructure zones, will stimulate additional renewable development and generation to come through onto the system. So this is a very interesting scenario, but unlikely to be where we end up in reality. Scenario 2 considers when data centre demand is matched with an additional 3.2 gigawatt of renewable energy generation. This is a significant mitigation and would limit price impacts to 7% in New South Wales and 6% in Victoria by 2035. And to put that 3.2 gigawatts of additional renewables in context, the Baringa base case, of which kind of all of this is modelled against, assumes an additional 55 gigawatt of wind and solar built by 2035 to meet existing demand. Scenarios 3 and 4 show that it's possible to further reduce the impact by matching data centre load with grid-scale storage solutions, as well as renewable generation. So this additional storage would draw excess renewable generation during the middle of the day, discharge during the peak, lowering the peak electricity price. This results in a strategy where there is a greater match between the load and generation, so similar to the 24/7 matching initiatives announced by Google and Microsoft, which they have announced and expect to implement in Australia by 2030. Reducing the need for that more expensive peaking generation. So by 2030, in scenario 4, during the 7 p.m. peak, our model scenario of renewable generation and additional storage, which matches data center demand, leads to a negligible price increase, reducing load-weighted price impacts to 3% in New South Wales and 2% in Victoria by 2035, and largely mitigates any increase in emissions. I should say again, what we haven't done in this modelling is account for further flexibility through initiatives such as workload shifting. And we have estimated through the work that we've done that shifting a further 10% of load away from peak periods would reduce costs by an additional 1% across both New South Wales and Victoria. So I think these scenarios are incredibly interesting to illustrate the range of mitigations which you can put in place to reduce the impacts of the data centre demand that we expect to see. But I will pause there.
Thanks, Rebecca. I think we've wanted these scenarios to sort of bookend a likely sort of series of outcomes, and then work within the space in the middle and see where we could actually, the reality is we'll probably end up somewhere in the middle of this by 2030 and 2035. Looking at this, there seems to be opportunity for a renewable generation and storage coming out of this group. What else do you see as an opportunity for investors in data centres coming out of your work on the report?
Yeah, it's a really great question. So, I mean, fueled by the relentless innovation of AI, the investment opportunity is kind of unparalleled at the moment. Australia's access to clean energy, the land availability, data sovereignty laws, geopolitical stability, subsea connectivity, all of those factors mean that Australia, in our view, as a region, is likely to continue to rank highly in terms of development opportunities. So I think data center demand is not just a challenge, it's a financing anchor for clean energy, and if managed well, could actually expedite significant renewable investment. Data centers will create long-dated, stable electricity offtake requirements, and these will be backed by strong credit counterparties who are able to utilize products like PPA. So it's a real opportunity if managed correctly. I think the other interesting thing about data centers is just considering a bit about the industry itself and what makes it different from other large load users potentially. So this is a relatively small, consolidated and informed industry. The big data center players have significant capability in the energy space. And I think this really presents a great opportunity for engagement and discussion around potential coordination of demand and supply. Data centers, unlike some other large energy users, have some degree of flexibility as to where they locate, and I'm sure we'll get into that a bit more as we go forward. And the business model is completely reliant upon secure, reliable power. That's the overarching concern of all developers. So I think with the right dialogue, the right incentives, such as using mechanisms by which we can accelerate the beta market, that's the overarching concern for developers as well. I think there is an opportunity and a possibility to draw significant coordinated investment across data centers and renewable generation. And I think this is the kind of precipice and the moment by which some of that dialogue needs to take place.
Yeah, and I think we've seen the opportunity, but you also want to have the balance with that. Thinking about that in a global context, Cornelia, General Atlantic, you recently released your own research report, Investable Green Data Centres, Where Sustainability Drives Performance. Are you able to touch on the purpose of this research and your key findings?
Yes, and thank you for the opportunity to share this work. Yeah, so we co-authored this white paper last year in September. We published it in September 2025, and we co-authored it with Systemic, who's a partner of Beyond Net Zero, our GA's climate fund, with Actis, so our Sustainable Infrastructure Fund, and we had 15 experts interviewed globally, and also sort of contribution of portfolio companies to get sort of a corporate view from the ground. We wanted this white paper. We sort of the audience for this white paper was the lay person who is seeing, as everyone's seeing, the increased demand in load and increased demand in sort of the surge in construction of data center to feed the increased demand in AI. And we wanted to sort of sense check where we were at in terms of industry standards, in terms of sort of what does great look like what does great look like when you think about green data centers, but also what are the opportunities outside of the traditional infrastructure plays? So what are the opportunities for, say, a climate growth fund like Beyond Net Zero? And I think the key learnings that we sort of extracted from our interviews and sort of discussions with different stakeholders is that sustainable solutions in this space will scale the fastest if they can solve a core bottleneck. So this is it's a euphemism to say that data center is an asset class that is a sub-asset class of infrastructure or real estate that is on the ascendant. Right now, the number one constraint that came up all the time was access to power. Obviously, there is an exposure to fossil fuel, and that creates some volatility. There's regulatory tightening, and that creates a growing financial risks. So sustainability solution, the stack, so sustainability services and solution and tech that enables a data center to be more efficient are actually sort of in high demand. And so we looked at the sort of stack of solutions. We looked at on-site renewables, storage, microgrids, demand flexibility software, and how they scale and how you should apply them to unlock grid capacity. And we do this, and I think the argument here is we do this and we look at this and we're thinking of investing in this not just because they're green. And one key argument that came up and is that right now $64 billion of US projects have already been delayed or blocked due to power, water concern, and acceptability locally. So I think here we have this. So as a sustainability professional, I would say that we have a sort of perfect alignment where sustainability equals license to operate. What we also found is that the opportunity set, this sounds all great, but the opportunity set is really uneven by geography. So maybe sharing, I know we're speaking here for Australia, but if you take a step back, Europe right now is completely policy driven and quite limited in terms of geography and what it can build. We know how much location is important, especially to hyperscalers. So right now in Europe, what's big is heat reuse, and they're probably at the forefront of the reporting and the sort of policy around renewable use. In the US, it's a completely hyperscaler-led environment, and gas is still considered as the competitive short-term solution. So we had less conversation about renewables. We're probably going to touch on this later, but we also uncovered there an ambiguity between what the hyperscaler at HQ would tell us in terms of environmental ambition and what we heard from the ground. So the disconnect between HQ ambition and how it's outpacing the local grid realities. And in Asia, so closer to home for you, there's more of a structural capacity gap. With what came up a lot is the high solar potential. So Actis, our sustainable infrastructure fund, operates in Southeast Asia. And what we saw there is that up to a third of Southeast Asian DCs could be powered by solar wind. So huge potential there for our energy transition fund. I think one thing I'd say is that what we're also seeing, and this reason why as a multi-asset class investor, we're really interested in data centers, that investors can deploy capital at multiple stage. So for example, Actis will be focused on capital intensive infrastructure in the global south, and the sort of other side of the coin would be what we do at Beyond Net Zero, which is a focus on capital light, sort of tech and service stack. And I would say I would say in terms of solution, and we can touch on this later, but what the one solution that came up to the most sort of proven solution, I would say, and that is not dependent on subsidy and policy, is a performance-led sustainability win is liquid cooling. So we sort of double-clicked on liquid cooling in the white paper.
Thank you. And thinking about that in terms of General Atlantic's investment in the sector, what are you doing on a particular sort of portfolio basis to tackle the decarbonisation of the sector? Are there any specific actions you're taking or market-leading metrics that you might have seen for measuring sustainability of the sector, or specific things you're doing as an organisation that would be interesting to the audience?
As an organization, we try to tackle this mega trend by breaking silos between asset classes. So I think typically, when we think about data, when we approach this white paper, this sort of immediate, and this is why, obviously you work in the infrastructure space, so the specialists and the experts are more often than not in the infrastructure space. But I think that what we could bring to the table with the climate growth angle is the notion of scalability, and it's a completely different sort of return profile. So if I look at our existing climate growth portfolio, we have, for example, a company called SDCL that is specialized in data center efficiency strategies. So it provides the services to data centers. So it will go, and so it has a data center efficiency strategy with 200 million in commitments in the last 12 months. So it will look at financing on-site generation and storage, advanced efficiency infrastructure for large load customer, including data centers. We also have one of our portfolio companies called GRESB. You might be familiar with it. It's the leading infrastructure and real estate sustainability assessment and ratings provider, and it's launching in Q2 a data center standard in collaboration with iMasons, because I think it's critical that we, I'm sure there must be a lot of sustainability professionals on the call, but we know that we've been, in the last 10 years, paying a lot of money for bad data and probably exhausting ourselves into reporting against multiple frameworks to arrive at the same, results, which is trying to assess in parallel with your financial sort of indicators. It's trying to assess whether or not the asset is sustainable and resilient. And I think we have a unique opportunity to agree, sort of to embrace the same assessment methodology or the same framework, and to look and collaborate with hyperscalers, for example, and so create the coalition now to speak the same language. So, for example, we obviously have connected Actis with GRESB, and I think that everyone today, when you speak to the players in the data center space, they will obviously say that the most important is location and access to power. And when you double click on the sustainability metrics, they will often stop at PUE, so power usage efficiency, and WUE, so water usage efficiency. And what was very interesting for us is to benefit from the incredible knowledge that Actis has, years of building data center in their real estate fund, and they've developed 7 green metrics to quantify resource efficiency over the life of a data center, because they develop data centers. And I think it's a nice way to think about this is 4 R's: reduce, reuse, recycle, and renewable. So within reduce, you have PUE, WE, but you also have carbon usage effectiveness, and the IT hardware, power overhead multiplier, so the power consumption of the hardware. The reuse is an energy reuse factor, recycle is material recycling ratio, and renewable is the green energy coefficient. So yeah, I think there is not saying that we should absolutely embrace this opportunity as this investment opportunity, but we do have a unique opportunity to overlap right now a sustainability framework to it.
Mm-hmm. And I think thinking about those wider metrics and the wider impacts of the build are important. And I've seen in the questions we've got a couple of questions about water. We did focus on energy and emissions. We understand completely they're inextricably linked at the moment with the current cooling that's used by the majority of hyperscale data centres. But because of our mandate focus, that was our focus for this report. But obviously the water part is extremely important as well. Thinking about some of the interplay metrics that you sort of seeing Actis maybe develop and GRES, Rebecca, if we're looking back sort of at the report and what we sort of looked there, we did some work on innovation and some relatively simple initiatives by data centres that could positively impact their sustainability, such as behind-the-meter BESS, where there's space, or off-site BESS, and long-term contracts, flexible connections, etc. I was just wondering if you could talk through some of those options, because I think they're interesting structuring pieces which maybe aren't coming into play at the moment yet in the Australian market, and could make a significant difference to the emissions outcome and sustainability performance.
Yeah, so I think as we've all touched upon, flexibility is one of the key enabling innovations which can be utilised to develop more sustainable data centres. The ability to shave that peak demand, flatten the duck curve and soak up some of those renewables is a really important mechanism. So if we start with large-scale battery energy storage systems, so BESS systems can either be located behind the meter where space allows. They can be strategically located near the data center to reduce grid impacts within those regional local areas, or they can be procured off-site under long tenor offtake contracts when on-site or near-site space is constrained. So I think the benefits of storage on the energy system prices is well known, but there is definitely potential for further innovation around the benefits of near-siting BESS in strategic locations to support network strength in a particular region. So we know that networks often want batteries near data centers, but at the moment don't always provide the necessary information to be able to, for developers to be able to quantify the benefit of this. So the types of information that could be useful and that we see in other jurisdictions actually are things like clear locational value signals, the development of standardized payments for deferral of network upgrades, so utilizing flexibility instead of just continued augmentations, transparent hosting capacity maps and long-term contracts for grid support services are just some of the ideas that I think are worth exploring further. And I'm sure some of our network colleagues on the call are probably sales that they're already thinking about this and working on it at the moment. But I think without these, the kind of missing pieces of the puzzle is that developers just can't quantify the value of being in a specific location over another. And we know that on-site or near-site BESS is a key enabler for flexible grid connections, which are being considered across the market. And this is where data centers agree to temporarily cap their usage during extreme periods or constraints. So potentially unlocking earlier grid access, for example, or enabling lower capex or network augmentation. But again, not yet aware of networks having detailed methodologies to better measure the benefit of near-site BESS investment when determining that connection capacity. So I think this is a really interesting space, and there is lots of work going on across other jurisdictions. So we know, for example, in the US that flexible grid connections are valued and are enabling data centers to jump the queue essentially. And there's lots of work going on in the UK, for example. So I think there's an opportunity here for networks and data centers to align and to think about these sort of near-site BESS, networks, data centers and developers actually, but to kind of align and think about these near-site strategic locations of BESS. So as well as battery energy storage systems, I think there's also potential for data centers to participate in virtual power plants, for example, so utilizing their backup generators, their UPS batteries, HVAC systems, and some IT load flexibility. So we know that Digital Reality here has 2 data centers offering grid services via their UPS generators as part of a VPP. And we know that companies like NLX, for example, has significant amount of data center load under contract already, and that data centers are a key focus of VPP programs going forward. And then I guess the final bit of the flexibility puzzle is the potential for IT load shifting. So moving that non-critical computing task to times of high renewable output or low grid stress, which is one element. And going further than that, actually kind of dynamic workload distribution, which enables the geographical redistribution of computing tasks based on energy availability, carbon intensity and pricing. And so we know that there are innovations and trials going on testing the availability of this and the amount by which data centers can flex. So US-based ServiceNext has successfully shifted its computing load from the Netherlands to the US West Coast and then back again to maximize the availability of solar power. And this reduced emissions for certain workloads by 34%. So I think we're in the very early days of this kind of IT load shifting and kind of geographical redistribution. And there will likely always be a cap on the amount of data center load that can be shifted in this way, because it really does depend on the kind of end use of that data. But it feels as though there is definite potential for further innovations in this space, and this has the potential to have a real impact on some of the kind of price and emission things that we talked about earlier. So a very exciting space, I think. And then I guess some of the other things that Cornelia's also talked about, like efficiencies in terms of PUE, cooling technologies and things, but probably covered that already, so I'll leave that one there.
And taking that, Cornelia, to sort of General Atlantic's focus, what are you sort of seeing as in terms of investments that General Atlantic's making in terms of innovation to address energy usage or carbon emissions from data centre growth in your markets? Are there any sort of examples that you might have seen in your portfolios? Or
right, and so I think it's we're certainly seeing, as I said before, sort of in the infrastructure yield. Sort of, if you think about this as sort of in deploying capital at multiple stages, and sort of from honest, you think about this as a stack for the infrastructure yield. You already have proven stable returns on solar storage, as you mentioned, and liquid cooling. And for liquid cooling, that's why we sort of double clicked on that. The data is sort of speaks for itself in terms of savings. And we, for example, and that's I think so it's easier, for example, to put it. So, for example, Actis already has a district liquid cooling investment in the Middle East, and your savings of 30 to 40% of saving. You're seeing 30 to 40% savings in electricity and water consumption. So the problem is that it's very hard to put this in place. When you're retrofitting a data center, it's much easier to do it from the ground when you're sort of building it from the ground up, so greenfield. What we're seeing on the growth equity side of things is that data center infrastructure, so DCIM, the data center infrastructure management softwares the opportunity set has exploded for us as investor. The pipeline is now full of DCIM softwares. There's also demand, to mirror exactly what Rebecca was saying, demand flexibility, software, chip design, optimization, microgrid enabling technologies. If anything, and I'm just sort of, I think it's pretty clear. It's sort of well-known fact. If you look at the data point today, it's the valuation feel very high. It's a very hot market. So it's really a question, really maybe a bit of a COVID time tech at the top of the curve issue. So are we ready to pay those multiples? And even though, and it's, which connects back to the question of, this is very much powered by the AI. You call it bubble or not, but it's very much powered by the AI demand. So we need as investors to think about, what is the curve going to look like? Do we still have a lot of potential to grow? Or do we think that the marginal incremental value we'll get from one more turn of the crank on LLMs that's done? And we now have a flattening of the curve around sort of LLM demand for power. There's also the venture high risk. We didn't talk about this yet, but the SMRs, long duration storage or advanced semiconductors, we're obviously monitoring this, but we've learned also from the hype around hydrogen, and we would not invest in. So we don't do VC, so we wouldn't invest in a non-proven technology. But obviously monitoring it very closely, and nuclear energy is going to absolutely necessarily be part of the solution. And I think, that's it for the moment. I see a lot of questions. So.
Yeah, there's a lot coming in. So and also Cornelia, I don't know, your video seems to have flicked off, but I'll go to Rebecca with the next question while you might sort that out. But thinking about the application of some of we've sort of thought lightly about technologies and a bit about the actual operation of the data center. How can energy market operators support more efficient energy outcomes for data centers, particularly given the current growth and the geographical concentration of that growth?
Yeah, I think that is a great question. So I think there are probably three things that would immediately come to mind. The first is around the queue and the visibility of the connection queue that we're seeing. So we know that there's double counting in the connection queue at the moment because the way in which data centers are procured, developers or data centers developers, they'll go to a number of people, they'll contact their networks, and we know that that leads to multiplication of the same kind of connection applications within queues. So the publication of standardized pipeline and connection queue data, so including things like, IT load ramp schedules, firmness, location, for example, to improve ISP and EC forecasting and the networks and transmission networks augmentation planning would be a really beneficial mechanism to ensure that we're not overbuilding and that we're keeping costs proportionate. I completely recognise that this would require some degree of confidentiality, but I think that that is completely manageable in the right way. The other is around the design and scale of flexible connections. So connections, grid application connections, which have clear curtailment regimes, notice periods, compensation, potentially, could be a real mechanism, positive way to unlock earlier access, but still maintain reliability of the network and reduce some of those augmentation costs that we're seeing and have talked about previously. And I think the other thing would be around, this is always a bit of a controversial subject, but the consideration of locational signals for new load. So is it possible, for example, to incentivize development of alternative data center hubs in areas where data centers and renewable energy can co-locate to increase efficiency and reduce network constraint? So this was one of the things that we looked at in the report and considered whether or not some of the renewable energy zones would be suitable locations for data center growth in the future. And I think it's definitely something worth considering and worth some further dialogue between data center developers, network operators, and energy market operators and government and others to just consider and test whether or not places like the Hunter Central Coast, RAS, Central Highland, or potentially Jutland in Victoria, for example, could be suitable locations to host data centers in the future, relieving some of that kind of constraint on some of those real urban areas around Sydney or Melbourne. Yeah, leave that one there.
Yeah, and I think following on from that too, can the PPA structures be priced to incentivise developers to offset load in a time match basis rather than an annual capacity based? Can there be other ways that you might drive the right behaviours in terms of managing the impacts on the grid?
Yeah, so the 24/7 matching and time matched certificates is a really interesting area, and there's a lot of evolution and development going on in this space. So, I mean, the market is evolving with the phased introduction of the voluntary time-stamped guarantees of origin here, which will ensure that market structures are in place to track generation, which is, a positive development from where we are now. I would say in addition to that, we're seeing a number of startups such as Granular Energy, who have recently actually published a report with Baringa, but a number of startups which are appearing in the market, which will ease some of those data and transparency burdens. So ensuring the mechanism is user-friendly and deliverable, which I think is really important. But ultimately, I think the commercials around the requirements and need and drive for 24/7 matching will ultimately be driven by supply costs and demand appetite or regulatory pressure, which we are likely to see through changes to the greenhouse gas protocol, for example, and the Scope 2 emissions, which are likely to come in the next few years. But I think important to note here that the type of data center that we're talking about has an impact on how easy it is to implement some of these kind of additional green requirements. So colos, for example, have different customer dynamics. So they are servicing a number of customers. They pass through the costs of energy to their customers. All of those customers have differing appetites for green. and varying degrees or kind of reluctancy to pay or not for some of those additional green products. And therefore there is kind of a, I guess, reluctance from some of those colo providers to commit, tie in some of those expensive green products when they don't know whether or not they'll be able to pass through the costs, and there's concerns around the competitiveness of that. So I think that's a really important point to note with all of this, actually, is that the different business models which are at play here. I think on the other hand, you have the likes of Google and Microsoft that have made commitments for 24/7 carbon matching by 2030, which is great. And I do think there is a role for retailers and other market players potentially to create more accessible products as an interim step. So we know that the last 10% of matching is exponentially expensive at the moment. So the development potentially of products which retail tariffs and products and other kind of offers which get to the kind of 75% to 80% time matched contracts would help overcome some of those existing kind of cost barriers that are in play, and just really provide that interim step whilst the market is developing to become kind of fully reflective of that 24/7 time matched, time stamped certificate.
And just before we head to the audience Q&A, I'll just throw one last one in, and for the coming and going of Cornelia, don't worry, she's in America and she's here, she can hear us, so that's the main thing, and we can see her, more importantly. Maybe Cornelia, what do you see as the biggest long-term sustainability risk that's facing the growth of AI infrastructure?
Yeah, I mean, I did warn Julia, I'm not a sort of I see wonderfully technical question, and I'm learning a lot from the question. So I'm going to give you more of a sort of generalist sustainability response to your question. But I think that, first of all, let's take a step back. I'm in the US right now for a company offsite, and we were just told today that in some states, the electricity bill has, in the trailing last 12 months, has increased by 217% in some states for single tenants or multi-tenants residential properties. So I think that just gives you when you talk to people here who live in the US, they will see, and again, it's state by state dependent, it depends on the type of property, but they will see that we're talking about electricity bills that can go from sort of $100 to $400 a month. And so the grid's bottleneck is going to be the most immediate systemic risk. The AI demand is excellent. And it's not only AI demand. I've seen this in the question. Obviously, it's not only AI demand. And we should be thinking also about autonomous cars, electrical cars, the IoT, smart sensors for the manufacturing in the facilities. It's also the hardware. It's not just the software. But basically, AI is going to accelerate. Is accelerating faster than transmission and generation build out. So infrastructure that can't secure resilient, scalable power becomes economically vulnerable. So that's one thing. And we saw that in Spain, for example, last year. There's also the topic of community and water stress risk, and that's rising structurally. Large-scale data centers are going to compete for power and water resources. And operators who don't manage these impacts early will face permitting delays, reputational risks, moratoriums like we saw in Ireland. And I think that's where the infrastructure playbook in emerging markets is a really interesting one. Is have you sort of, when you're about to embark in a development project, have you done a sort of stakeholder, a local community impact, an environmental impact assessment, a biodiversity impact assessment? And so there's a lot to borrow from the infrastructure playbook there. That in the speed of the build-up we're seeing right now, especially from dictated by hyperscalers, probably is not being done. And the last point is, I think maybe not flippant, but I think we should be thinking about data centers as a potential stranded asset risk from technology evolution. So first of all, there are a lot of data centers out there that have been existing for decades. So what do we do with the sort of 30-year-old hardware? Can we replace it? we have to think in terms of hardware circularity, and availability of spare parts. It's one thing to build the data center, it's another thing to operate it. And it's another thing to keep it up in 10, 20 years. Will you have the spare parts available? Have you been thinking, basically, have you been factoring this in your plan? So if anything, I think sustainability, adaptability will be huge, and which sort of leads me to the last point, which we're probably going to make around the vulnerability, the climate vulnerability of these sites. Some of these data centers are being built in geographic zones that are very vulnerable to climate change, so chronic or acute physical climate risks, and it's absolutely essential to think about that in the assessment, and also think about climate insurability.
Yeah, and it's well, I think there's kind of a lot, and the questions reflect there's a lot in this topic, and obviously our report doesn't cover everything because there's so much to look at. So what we'll do is we'll flick to some of the questions now, I think, because there's quite a number of them. There's been one we've got specifically on some of the material Rebecca was talking about around location of data centres, and suggesting, could you put data centres in regional areas like North Queensland, which would be a long way out, but be cheaper to transport data than power, and the grid connection and building out the grid might be more expensive constraint than building out the data connectivity or co-locating energy and data. And I think we've touched on these topics, but might be good to put more sort of colour around that.
Yeah, it's a hot topic at the moment, the location of data centres and whether or not we should be incentivizing development outside of the existing urban hubs that we are seeing. And we did touch upon this in the report, specifically considered whether some of the renewable energy zones or other kind of urban non-established areas would be suitable places to host data centres. So I think there are a number of factors that come into play here. So when we're thinking about the suitability of locations for data centres, we have to think about things like fibre connectivity, proximity to infrastructure, so grid, for example, the proximity to a skilled workforce, which actually is really important. So data centres require a highly skilled workforce, not only obviously through the construction phase, but also actually through operations. And therefore that is a constraining factor to having some data centres located in really regional, remote areas. There is something about the proximity to population, so where the data is actually going to be used, and those latency issues that arise from that. So some data use cases, it doesn't really matter how far away it is, some of the AI training, for example, but some things has to be pretty instantaneous, and therefore any additional kind of latency is going to cause a bit of a problem when it comes to those data centers using it and customers' appetite to locate in areas away from those urban populations. The other big thing that came up through our discussions with data center developers on this was the availability and proximity to cloud availability zones. So cloud availability zones are really important for data centers because they provide kind of redundancy, resiliency across data centers. So data centers typically cluster together, and then they kind of utilize the cloud availability zones within that. So if one of the cloud zones falls over, then they kind of hook up to another, and that enables them to ensure that continuous operation. So it's actually really, really expensive to create and develop new cloud availability zones outside of those existing hub areas. And then obviously, some of the positives around locating outside of some of those urban areas are around kind of your ability to co-locate with renewable generation. So easing any grid constraints and congestion, curbing some of those kind of loss factors, and just making the economics of those renewable projects just more positive and beneficial. So there's quite a lot in the question around location. And I think the general feeling is that data centers will always choose to locate in those existing urban hubs unless there are significant incentives which require them, or consider them to think about locating elsewhere. So one of the things that has come up before that I've heard talked about a lot is, do we incentivize faster grid connections, for example, so faster development by using some of the access schemes in renewable energy zones? So not mandating data centers to locate in a specific region, but incentivizing much faster speed to market if they consider locating in some of the renewable energy zones or alternative areas. So I think this is one area that definitely deserves some further consideration with government, developers, networks, to consider the feasibility and just really think through whether or not there are any of those mechanisms or incentives that you can put in place to consider some of these options. So I think at some point data centers will bump up against network constraints in some of these more urban areas.
And I think, that's been evident in other markets already. And probably we're having a little bit of a run before that happens in Australia. But it's obviously become a much hotter topic over the past 12 months, definitely in Australia. I think in thinking about that, Cornelia, too, you mentioned there's a disconnect between headquarters, HQ, and what's happening on the ground. Do you see in other markets any sort of role that regional development organisations or councils or other bodies might be playing through policy or other support to encourage that, maybe that location to where the power source is better and take some of that pressure off grids? Are you seeing any of that sort of having impact anywhere that you've been working with, or is that sort of a bit outside where you've been dealing?
So obviously we look at this from a pretty US-centric perspective. So the current administration is holding hearings at the moment around, and it's not. I think we're nowhere close to having a sort of a structured federal level policy in the US on data center. It's certainly not around green data centers, but there is a sense to I think more and more the necessity to make sense of the chaos. And there's a huge, as I mentioned earlier, what drives the policy discussion in the US is the question of affordability, given the amount of risk it creates, the political risk it creates for the current administration. Also given that they've sort of openly waged war against renewables and have blocked several projects that were meant to sort of be a bit of a solve to that issue. So that's what currently in the US, I would say we're not expecting much in terms of policy. What we're seeing, all I could say is that, and I don't have data points for this, but you will all be familiar with the announcements that are being made at HQ level by the Microsofts and of the world who will make net zero commitment or 24/7 clean energy commitment, and it's hard. I think it's the euphemism to say it's hard to see this translated in the ground. So locally, when we interview the same team, so one thing I should say first is we get very different messages from different teams within HQ. You don't get the same message from the data center team, the supplier team, and the cloud team within the same players, so Microsoft, Amazon, or Google. And when you go underground development priorities remain: 1, speed to power; 2, reliability, really high uptime expectations; and 3, cost and time to market. So that's sort of a given. And then you sort of fall back on the constraints, the geographic constraints that we talked about earlier. The silver lining is that the industry, and I say this as a sustainability professional because I'm contending with I typically receive 200 questionnaires from my investors on an annual basis, and they all ask more or less the same thing in a different way, in a different format. I think one can hope it won't be the same for data center developers and operators. And I think, for example, you have GRESB's upcoming data center assessment. iMasons has put out a climate accord maturity model. You also have something called technology readiness level scoring. And we've heard that there is a bit of coalition of the willing that's being built around Microsoft for hyperscalers, where they would be sort of agreeing on a common common metrics, core efficiency metrics, such as PUE, WE, but sort of a broader list. So that's what I think it's very much in flux and a space to watch.
And those sort of options, they're things that financiers could use to structure their investments or make as requirements of their investments. And that would help direct the capital to the projects that are better from a sustainability perspective.
Yes, I think that, it's that's what ACT is. So, for example, ACT is you can say you're constrained by the environment, but ACT is typically sort of ACT's DNA is to be a sustainable infrastructure player in emerging markets. So a good example there is we kind of know, I think we all know what a perfectly sustainable data center would look like, and I think Rebecca has alluded to this in the conversation, so solve the power constraint, optimize the operational embodied emission, and treat sustainability, as sort of as a win when you think about as a win. So for example, developing sustainable data center solution. Right now, we think it's attracted 3 billion of investment just last year. So we see it as an investable opportunity, which is why we wrote the white paper. But we're also witnessing examples of a perfectly sustainable data center. So for example, Actis has developed an urban data center project in Taiwan. And what it means is, like, for example, once fully operational, so first of all, when you design it, it's designed sustainability first, not retrofitted later. So there's a water-cooled system instead of the typical air-cooled design. Once fully operational, it's expected to save 60 million kilowatt of electricity and 200,000 cubic meters of water. It uses a certain amount of renewable power. It targets a minimum of renewable energy mix. And I think it will aim to adhere to local certifications, so the local LEED and EDGE and the Taiwan Green Building Silver certification. So what I mean is that we're not discussing this in a void. I think it's a question of prioritization, and the financial space has a huge role to play in asking the right question. So if I take a sort of diagonally, if I take another example, a trailing edge example, if you think of the real estate space 15 years ago, Berkeley was a bit of the Far West, and what GRES has done with its assessment that's been picked up by thousands of participants, with more than 200 LPs, so sovereign wealth fund, pension funds, banks, and investors, and more than 1,500 GPs, is that there is a consensus today on what good looks like. So you have a scoring system, a rating system for real estate, industrial, residential, and commercial. And there's no reason why we couldn't have the same for data centers. And I think the financial LPs like yourself have a great role to play there.
Yeah. I think you're right. It's at the start and it's kind of nascent. I'm kind of conscious of time. We've got about 45 seconds left. So I think we could do one quick question, but ahead of that, I will thank you all for the huge amount of questions you've provided. If we get cut off on the last answer, that'll be it. But thanks so much, Cornelia and Rebecca, and I hope this has been interesting to the listeners. Rebecca, maybe one that we were leaving with, if we've got a few seconds on, is what's the one policy change that would most accelerate clean energy and firming aligned to DC connections? Just to leave it on a hard note.
It's tricky. So, I think we've touched upon most of these things already. So I think further consideration around locational signals and incentives, whether or not we should be requiring data centers to explicitly kind of procure additional renewable energy as part of their, development consents, for example, is one issue which is talked about a lot. I think that has the ability to have significant, amazing positive impacts. But I think if government was to go down that route, it would have to be done in a really intelligent, sensible way, because you need to make sure that the pipeline of that renewable generation is there. And certainly things like the ESIM and other policy mechanisms will provide an important kind of supporting role with all of that. But we need to make sure that grid connections are fast enough to match demand and not creating bottlenecks. And we need to think about some of the business models of the data center. So how it maps across to colos, for example, who have, customers with varying needs. How do you account for ramp rates? And uncertainty for demand and all those sorts of things. I do think there's lots of ways in which you can overcome all of those issues that I've just mentioned. So I think there is absolutely kind of room for manoeuvre here, and I think that Australia is in a really exciting place in terms of, unlike lots of other jurisdictions who have had to kind of slam on the brakes because demand has just outstripped supply and it's been exponential. We are kind of at the beginning of that curve at the moment, and so there is really some space and room and time to have some intelligent dialogue and make sure that we are stimulating not only the kind of data center development, but also alongside that, like really intelligent kind of procurement and buying of renewable energy as well. So lots to say, lots to do, but a good kind of moment in time to grasp this. Yeah, that's a good positive note to leave it on. The opportunity is there, but let's do it with thought. Thank you, and thank you everyone for listening, and hope it's been enjoyable, and we'll send out the links as part of this, and the webinar will be available on our website as well. Thank you, Julia. Thanks, Cornelia.
Thank you, Julia. Rebecca.